So unemployment, owner equivalent rents part of CPI, which is the large part of it, all of that stuff lags by 15 to 18 months. So even where the ISM today is bottoming, that means that that doesn't bottom until next year sometime, which is why the Fed are always cutting into the second year, because they're following the lagging indicators, the things that drive down CPI, which is why they're always late tightening. Unemployment, well, you're at the point in the cycle where unemployment ticks up. I don't expect a big tick up, but 4.5 through to maybe upside of 5% unemployment. Well, if you think of how lagging unemployment is, it's about 12 months lagged. So again, that keeps the Fed cutting.
Earlier today, Bitcoin prices fell below $58,000 for the first time in 2 months to $57,168, according to CoinMarketCap. The sell-off followed action on Mt. Gox wallets and the German Federal Criminal Police Office sending $175 million worth of Bitcoin to Coinbase, Kraken, and over-the-counter desks. Late last month, the collapsed exchange's Rehabilitation Trust stated it would distribute 2014 hack assets. The exchange's website also announced both Bitcoin and Bitcoin Cash would be used for payments, which analysts cautioned could briefly generate selling pressure in both cryptocurrencies. Mt. Gox, according to blockchain analytics firm Arkham, conducted test transactions earlier today, moving $25 worth of Bitcoin across 3 transactions to different wallets. This test may indicate an intention to start the redistribution process, as large crypto holdings are known to conduct similar tests before making larger transfers. This news has shook Bitcoin markets. Vision founder and CEO Raoul Pal has updated his outlook and expectations for the cryptocurrency market in 2024 and beyond. Pal says a missing detail most investors are not paying attention to is global liquidity. Gish and I, in a recent interview with Blockworks Macro, the famous business executive and macro analyst explained that liquidity is a major part of every crypto bull market and that we are just at the point where liquidity conditions are expected to improve significantly, causing an immediate response in asset prices. While Pal expects most asset classes to perform well over the next 12 to 18 months, he predicts that cryptocurrencies and digital assets will.
Talking about for a while, I think we're in that transition from macro crypto spring into macro crypto summer. Now, people confuse it with the actual season itself. I just saw that on Twitter. I'm like, no. It's because it breaks down to 4 periods of the liquidity cycle that drives assets. So the transition here is usually when the forces are still disinflationary and growth is slow to picking up. That is like macro utopia. Why? Because that tends to push the central banks into adding liquidity and the governments to adding liquidity. It also happens to be this everything code cycle is also about the election cycle. And guess what politicians do at this time as well? They want to give candy to the kids. So they're stimulating as well and tend to stimulate into the following year as well. So that particular juncture of the macro starting to pick up, the ISM survey is still below 50. So it's still sluggish. The forward-looking indicators are all very positive and liquidity has been positive for a while. That pickup, if you think of it, we've had a Wall Street recovery, which is liquidity. Main Street recovery is yet to happen. Main Street is when earnings go up and all of our earnings go up and there's a bit more money around. That's when the flows from all of these earnings start going into markets as well. So it's not just liquidity and debasement driving things. It gets driven by actual investment money, which has been actually quite lacking in many respects. So that's typical of the crypto summer. So the crypto summer starts around now. It also forms the basis of the banana zone. And that's when things start to get really crazy. If we go back and look at all of these, since about 2008, they've all done roughly the same thing, which is presidential election cycle. It kind of has a sell-off into the summer. Then it tends to accelerate sideways over the election because everyone doesn't know what it means. And then it's all over, markets rip. Whatever the outcome, a shock, expected result doesn't matter. And so that election cycle has been very prevalent both in equities and in crypto. So that's where we are in the cycle now. So we're just in that zone of, we've got this beautiful chart pattern that is just consolidating. The stuff that has less network traction or network adoption has fallen significantly, but we're starting to see the recovery. So I think it's only a matter of time now before we start to see the next move. And that's also likely to coincide with some other liquidity things. I think the Japanese have to intervene with the blessing of the Fed, because that's going to help the Chinese, the Japanese, everybody's business cycle. That has to come because the US dollar is far too strong for this point in the cycle. The other thing that needs to happen alongside that is the Fed absolutely have to cut. And I saw you talking on Twitter today. Look, inflation, the true inflation numbers at 1.82. Core CPIs is now headed lower sharply, but rates are at 5.5. It makes no sense considering the lag that it has. If not, they're going to undershoot inflation, which I don't think they mind because you can refi debt at lower levels because they put everything at the short end right now. Janet Yellen's been issuing short end debt. So the lower she gets rates down, the more she can get back into the 4-year cycle.
Pal is sure that the only reason the Fed is still being hawkish is because of the lagging indicators it uses. As an example, he uses unemployment as an indicator that lags by about 12 months. According to recent reports, the number of people applying for unemployment benefits for the first time went up in June, and the number of people on unemployment rolls also went up. Rose, showing even more of a gradual. The markets are still hopeful that the Fed will start cutting rates this year, maybe even as soon as September, because the job market is cooling and inflation is going down. According to Joe McCann, founder, CEO, and CEO and CIO of Asymmetric, a crypto-focused hedge fund, it would not be completely surprising for the central bank to announce an emergency 25 to 50 basis points rate cut at the next FOMC meeting between July 30th and July 31st. If unemployment and other indicators get worse or better before then, the markets will still be very optimistic, and prices will go up a lot. Let's go back to Pal's talk.
The Fed only operate on two things: unemployment and inflation. Both of those lag the business cycle itself. So unemployment, owner equivalent rents, part of CPI, which is the large part of it, all of that stuff lags by 15 to 18 months. So even where the ISM today is bottoming, that means that doesn't bottom until next year sometime, which is why the Fed are always cutting into the second year, because they're following the lagging indicators, the things that drive down CPI, which is why they're always late tightening. Unemployment, well, you're at the point in the cycle where unemployment ticks up. I don't expect a big tick up, but 4.5 through to maybe upside of 5% unemployment. Well, if you think of how lagging unemployment is, it's about 12 months lagged. So again, that keeps the Fed cutting, even though the business cycle is going to start gaining strength. So you'll have a weird world, and it happens at every single cycle, where the ISM's at 55 and the Fed is still cutting like crazy. And everyone's like, what the hell is going on?
Yeah.
It's because they just follow those two indicators and they're both lagging.
Mm-hmm.
And we live, in Global Macro Investor, Julian Patel and myself, we live in the future by 9 months because we use financial conditions, and financial conditions lead the ISM. And it's been screaming higher for a while.
It sounds like both of us agree that for the most part, they should be cutting right now. Do you think there's a risk of them doing this classic thing where they, end up misstepping right at the turn and end up cutting too late? Or do you think they're still on track to be on time here?
I think they could have gone earlier because a lot of this was baked in the cake a while ago. If you look at the forward-looking indicators, they've all been disinflating for ages. Don't assume central banks are stupid. That's a lesson I've learned. Assume that they know what they've got to do. If the game is, we need to roll $10 trillion of debt this year, and the Europeans have to, and the Chinese have to, and the Japanese have to, and everybody else, the best single thing would be to lock that in for another 4 years at the lowest possible rates. So it's kind of like, maybe there is a game here, which is to undershoot. I've observed that they're all in cahoots with each other, all of the central banks, plus all of the governments. So there's no independence of central banks. They're all working together. You can see how Janet Yellen and Jay Powell operating the TGA, the reverse repo, they're completely working together. Same in Japan, same in China, same in Europe. Everybody's doing the same thing. Mm-hmm. So I kind of think if they're doing it late, they're doing it on purpose because they're not stupid. They can see the same models. What? My work is better than all of the people at the Fed? No, they're choosing to do it for a reason.
Yeah, I think that's a super important lesson to have. The big question is, I agree that, these central banks are all talking to each other all the time. But as you mentioned earlier in your conversation, they're talking about what's been going on with the yen. And something I try to figure out is what matters more, domestic interests or international interests? Because as you mentioned, we've seen the yen jump over 161. The best way to solve that issue right now is for the Fed to ease, but we're seeing them be a bit slower on there. So I'm curious what you think about how much they, when the rubber meets the road, which side do they care about most, the global interest or the domestic?
I think they're all the same thing. I noticed that Yellen went to China twice, right? Well, what's she doing in China? It's something to do with their debt refinancing cycle, because they need dollars, because their entire property sector is a dollar borrower, right? So they've got a dollar shortage. There's a global dollar shortage going on. It started Silicon Valley Bank, all of that, rolls into Credit Suisse, blows out. Credit Suisse, big part of the Eurodollar market. Then the Japanese banks, they're the epicenter of the Eurodollar market. What's happening is they're starved of dollars. So dollar yen starts falling. And then Yellen goes to China twice. So Yellen needs to orchestrate this little dance. The dance is using Japan to scare the Chinese to do something.
In other news, the International Monetary Fund, IMF, suggested that the Federal Reserve keep interest rates the same until at least late 2024 and improve its finances by cutting costs and increasing income. Kristina Georgieva, managing director of the IMF, said last week in Washington, D.C., that we expect core price inflation to end this year at around 2.5% and be back to target by the middle of 2025. We agreed that the Fed should keep policy rates at their current level until at least late 2024, even though we know there are big risks on the upside. It's worth noting that the IMF had previously warned that the Fed's wrecking ball would hurt other economies around the world. What do you think about the sudden change of heart? When do you think the Fed is most likely to start cutting rates? Thank you for responding to Pal's interview. Please leave your thoughts in the area below. If you like this video, please give it a thumbs up and subscribe to the channel. You can also turn on post alerts to see more videos like this.